Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Do you want more? You do. You know you do. You want more. Everybody wants more. What do you want more of? You want more security. You want more comfort. You want the ability to do more. And to do all those things that you want to do, you do need dough. And that's what we do on the Talking Real Money show. Hi, everybody. Don McDonald here. Tom Cock over there. Making faces at me via the internet. It's the internet is actually pretty cool when you think about it. It's kind of, the fact is I'm literally looking at Tom and talking on the radio and recording a podcast and talking to you wherever you are. And it's amazing. I'm in
and
Florida,
you're juggling.
Washington.
Look at your juggling. You got apples there, oranges. That's pretty good.
Yeah. Knives, fire. Oh, let's bring in the fire. There we go.
Not in that small room.
Yeah, well, you got to keep it under control, and that's what we do with money. Is we try to keep these things under control because we all have a nasty habit of taking this stuff to heart, and you got to stop doing that. Everything in moderation. 855-935-TALK is our phone number, 855-935-8255. And one of the things that you should take in moderation is your portfolio. We all want to be in the place that's the hottest. And for the past decade or so, the place that's been the hottest for stocks has been the U.S. But what about international investing?
Yeah, that's interesting. The last decade, the S&P 500 has advanced at 17% a year clip. Don't count on that for the next decade. And meanwhile, Europe, Asia et al. Has advanced at about 8.5%. So then people say, well, I don't want to own those international stocks because they're crap. And did it save you in the downtime? No, actually last March, everything went down. And even in 2008, kind of again, everything went down. So people always ask us, well, why am I owning these international stocks?
Why? I sigh when they do that because, again, it's kind of short-sighted. Why, Tom? Why do we own international stocks?
There's a couple of reasons. First of all, there are periods of time, and you can go back and research this yourself, but 10 years, 2000 through 2009, the S&P 500 actually lost money, but being globally diversified. Here's the important part. Globally diversified into many asset classes, types of stocks, small, value, all those things, you made about 7% a year, far better than the S&P 500. And then if you want to go back a little further, how about 1970? That's the first year that Don McDonald plays Santa Claus. And if you put your money in
1973.
Okay, if you put your money in a globally diversified portfolio since then, you've advanced at about 12% a year. The S&P 500, 10.5%. So, okay, but even if you don't believe those
that
numbers.
That is a powerful number. That
a year,
one.
1.5 a year. It's
a
lot of money.
1970 to 2020.
Yeah.
That's a powerful number because we're talking 50 years here.
Even if you set all that aside and say, I don't believe any of that. Okay, here's things I think you can honestly believe. Number one, who knows which countries are going to be the best for the next 20 or 30 years? No one knows that. Number two, when you spread the money out, you're simply exposing your money to other countries, other great ideas, other things that'll be great companies. We don't know when or where, but that's what the case has been. And guess what? When you do that, you pretty much have to reduce your risk because you own more stuff. So I think that makes a lot of sense.
The other thing that's really interesting, and we talked about this about a week ago, we talked about the demise of the 4% rule and how Morningstar is saying it should be a 3.3% rule. But what's interesting about both of those assumptions is they're based on a portfolio that is all in the U.S. and diversified. 50% stocks, 50% bonds, all in the U.S. And the guy who came up with the 4% rule said if globally diversified. He believes that history supports almost a 5% withdrawal rule. So that global diversification can give you more money potentially in your pocket. That was a 95-year period, by the way, that almost 5% would
Tom
have worked.
and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Can I finish one thing here too? I knew
You dove
I
right
had
into
to
the pool.
interrupt.
It's like, psh.
Okay, because we've talked about this thing for like the last 3 shows. We talked it.
You're talking about the 4%, 3%,
4% or 5% or
4.7%?
3%.
Yeah. Uh-huh.
Okay, 2 things around that. Number one, no one knows the correct withdrawal rate until you're what?
Okay, you said that
Dead.
last time.
I know,
Dead.
because I'm going to keep saying it. Number 2, no one knows the correct withdrawal rate because no one knows what's going to happen to stocks and bonds, et cetera, for the next 25 to 30 years. Sorry. There's no guaranteed if you do 4% it's going to work for 90 years or 3 years. Nobody knows that. But get professional advice. I'd still say that.
Killjoy.
Anyway, sorry.
Now,
Happy holidays.
Now
Happy
what do we do
holidays.
for a rule of thumb?
Happy holidays.
And you know, before he chimed in, we were having such a good time, weren't we? Weren't we having fun?
Sorry.
We were making money fun. And then Tom just he
Welcome to Christmas.
he precipitated all over our parade.
Wet Weather Willie coming next.
Weather Willie in Western Washington.
Got it covered.
855-935-TALK is our phone number. Oh, golly. Yeah, it's fun, isn't it? Tom, not that Tom.
Oh,
another
yeah.
Tom. Tom, you're up. Welcome to Talking Real Money.
Thank you, Don.
Thanks for hanging in there.
Tom and Don. Hey, you have a very good show. I've heard you guys for at least 25 years since they started Roth IRAs, which I got a Roth IRA in Fidelity Contra Fund. It's done really well. It's probably 12, 13% up to, not looking at this last 18 months. But so I got some Vanguard inheritance money I'm trying to clean up. I think it's in Wellington and Wellesley. It's only done like 4 or 5% in a year. And I'm kind of curious what they have. It's similar to ContraFund, FCNTX, and how volatile
Well, okay.
ContraFund.
One, let me back up and tell you. Yeah, Contra. Oh, I have to
Everybody
do one of
loves
these
Contra.
I have to do one of these mea culpa
Yeah,
things.
I know.
I was, and by the way, I just read in the book Trillions that John Bogle was an advocate of active management
Yeah.
just before he changed his tune. So I have good company. I used to believe that actively managed funds were good, that somebody could actually do something and improve returns. And Contra, while it has been a very good fund, also has a higher degree of volatility and a high expense ratio.
What is the expense ratio?
It's
60?
0.86%.
So,
It's
okay, so
almost
just
90 basis points.
to go back, this has been a very long managed fund by Fidelity that is actively managed. It's primarily large U.S. companies, primarily.
Mm-hmm.
And it's had some very famous managers over the year, had a, as you said, terrific track record. It would not be a fund if we woke up today, Tom, that we would tell you to go buy, nor would we go look at Vanguard for the equivalent of which you may just have mentioned, because
No,
would
as a
you
matter
say
of fact,
Wellesley or
if I was looking for a replacement for Wellesley and Wellington, and you wanted to stay within the balanced arena, I'd probably look at the Vanguard Balanced Index Fund.
low expense,
Low expenses and
decent
expenses now.
diversification.
All of the evidence says expenses matter more than anything else.
And you can get the stuff. You could own Vanguard exchange traded funds for a third of that. I mean, they're so inexpensive now. So, no, I would not look for the equivalent there. And here's another thing. You mentioned the returns in the last year. We're going to tell you that's irrelevant. Really. I mean, returns in the last year, meaningless. Nobody knows. Returns even for anything less than about 10 years.
Well,
than
I'm
important.
looking at year to date on Contra. It's 24%.
Which is about the S&P 500. The S&P 500 is up 23.8%. So
It ain't half bad. But it's that expense ratio that really kills me. That's the thing I look at and that scares me. And then the other thing about Contra is because it is a managed fund, they are going to have a much, much higher turnover rate than a balanced fund. Plus, they only hold 325 stocks.
And remember, we're always trying to encourage you to own 10,000 companies, not 300.
Right. Because you're picking then. And if, the thing that's funny is that their top holdings, Tom, listen to this list of top holdings. Ready?
It's going to surprise me.
It's going to surprise you. Meta.
Yeah.
Facebook.
Mm-hmm.
Basically. Amazon.
Ooh.
Microsoft.
Shocker.
Berkshire.
No.
Apple.
Huh?
Alphabet.
Mm-hmm.
What does that sound like?
What's about Tesla?
Oh.
Come on, man. Anyway.
Dude, I don't know that Tesla's here.
Ooh. Elon's going to be unhappy when he finds out it's not a big part of
because it's a Contra fund. Because you don't buy, you don't buy the hot stuff, right?
By the way, that was my dad's favorite fund for a long time. Loved him some Fidelity.
It was one of my favorites back when I believed
that.
in active management.
Yeah.
But I don't anymore, and I don't think you should because the evidence does not support it. Every once in a while, you get an actively managed fund that's really, really good and can even have an extended great run, but still the more likely explanation is luck rather than skill. That they're just a little luckier than everybody else. 855-935-TALK is our phone number. And Mo, you're next. Welcome to the show.
I have listened to you guys for years. When you guys were doing live seminars, I went. I just have three quick questions. One, you guys are mentioning now you're partnering with another firm, Appleby or Applegate or something. Is there a reason for that?
Applebee's. We love Applebee's.
Applebee's.
Yeah, we like the salads.
Free dessert. Oh, I was going to say the free dessert.
Free dessert. No, it's called Appella. We merged with a company, a national company
I think I
called
like
Appella
this.
Capital.
Let's leave
It's
it at
not-
this. I
yeah.
like
No,
Applebee's.
it's funny.
All right.
But it's Appella.
Yeah.
So what's the question, Mo?
All right.
That's great.
And your retirement split still 60-40 for retirement?
It depends on the person.
Yeah, there isn't one.
Okay.
And he's referring, by the way, to a stock to bond ratio. There isn't one solution for everybody. The solution should be around your willingness to accept volatility, who you are emotionally. Number two, what rate of return and risk you need to take for retirement, sort of the balance between those two things, and how soon until you're going to start pulling that money out. When we work with clients, this is a very sophisticated analysis that goes into all that and puts together a plan that says, here's what we think makes sense. But there isn't one size fits all for anybody.
Okay. And one last question. Seems like a year back or so that you guys were talking about regular mutual funds versus ETFs. I'm in Vanguard. Should I be going to ETFs instead of standard mutual funds?
Maybe, maybe not. I wouldn't rush to make any big changes because unless, of course, you're moving from a mutual fund at Vanguard to the exact same ETF, so there's no tax hit on those. But there's no rush either. The difference between Vanguard's Admiral shares and their ETFs are in the single-digit basis points in almost every case.
But if you were starting today, especially in a taxable account, money that's not in an IRA or Roth, definitely I would start using the exchange traded funds there because not only low expense ratios, but more tax efficiency.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
It's a great idea, by the way. We should affiliate with a restaurant. I think that's smart. Well, no, I think that's smart for us to affiliate with it because then all the free food, right? That would have been a better move for us.
wait.
Way better.
No,
I know we're going to
this
get
is
trouble
nothing.
back
This
in the
is
home
nothing
office,
new. No. Wait a minute. You owned a radio station. I know you've already done this because every radio station in America.
That's true.
Every radio station in America lives on trade, on
Don't tell the
trade.
The IRS going to call me for stuff that happened 30 years ago,
I
man.
think you're past the statute of limitations
All right,
on the
good.
food trade. But I mean, it was like,
that's true.
I'd get off the air and the general manager or the sales manager would come and go, here's $20 at a restaurant. Just go eat.
Go for
I'm going,
it. Yeah.
thank you. Thank you.
perfect,
Because I'm a hungry, underpaid talk show host.
Exactly.
Because when I was doing local radio, I was making $500 a month.
That was in the beautiful state of Colorado, right?
KVOR.
KVOR.
News Radio, Colorado Springs. Yeah,
Back in the day.
I was the 9 to noon guy, Monday through Friday.
General Talk, or was this was
General
not
Talk?
financial? Huh?
No, General Talk. General Talk.
Good
It's
at
what,
that.
and it got me on KOA in Denver,
Which made the whole career go.
Torch.
Yeah, 50,000 watts of
Yeah,
power.
and guess what? This was before I did financial stuff.
Mm-hmm.
And when I was on KOA, I used to fill in for Dr. Andrea Van Steenhouse,
Dr.
who was the shrink. I used to do the shrink show.
Wait, well, you filled in for the shrink?
I did. I filled in for the shrink. I filled in
Yeah,
for every.
that's
I was the
kinda
fill-in
scary.
guy. They would go, somebody's
I
on
see.
vacation. Don McDonald will fill in. He can pretend to be whatever.
Your hopes, your dreams. Don McDonald now with your questions about your
Frasier.
emotions. Yeah, okay.
I was Frasier before Frasier.
All right. Well, if you have any questions along those lines for Don, he's here today for you as well.
I will talk about anything.
Yeah, you will, actually.
I will.
Some of it will be
about
meaningful, hopefully.
Most won't. 855-935-TALK is our phone number, 855-935-8255. Or, as we say, you can send your questions in.
But call right now because it's a good time. There's nobody on the
Talking
line.
Real money. Yeah, what will happen is we will get 17
9 calls between now and the top of the hour.
20 minutes till the top of the hour.
Yeah, so call right now. That's my suggestion. All right, what's the question? Hit me.
I have a question.
Okay.
Do you want to know the subject?
Nope.
Okay. We'll just do the question. I have avoided including bonds in my taxable brokerage account for a couple of reasons. First, when I started investing a long time ago, I could find information that helped me be comfortable with my choices of stock-based mutual funds and ETFs, but I couldn't find the same level of information about bonds, so I just put off adding bonds to my mix of index funds and ETFs. Second, I never felt the need to seek stability that bonds provide. I will have a very generous pension that will more than cover my expected expenses, and I have a Roth IRA and HSA that will provide a buffer should my pension fall short. My Roth is invested in a target retirement fund, so it does have some bond exposure.
Mm-hmm.
The bulk of my investments are in a taxable brokerage account that does not include any bonds. I don't anticipate ever needing to rely on the money in this account to cover my expenses. I am hoping that eventually it will provide supplemental income for my son. He has some disabilities, and while he is able to work, he is unlikely to be able to earn enough to be truly self-sufficient. Since my goal for this account is to maximize the potential growth, is it necessary to include bonds? I know bonds are a way to hedge against volatility, but if I'm looking at another 30 or more years, is it better to stay all stocks for now?
If you're never going to spend the money and leave it to somebody else, I'd say 100% in stocks makes total sense.
Yep.
If this is money you're going to need at some point, then yeah, some bonds. And by the way, back to that 4% rule. Interestingly enough, the guy who wrote the 4% rule 30 years ago, or whatever it was, he even says you should be balanced between stocks and bonds because there were periods of time where stocks go way down and need the bond money to draw from. But in this case, no, I think that makes total sense. Leave it all there and away you go.
I'm going to
sure,
add
why
a
not?
however.
Yeah.
I'm going to add a however, and that's the psychological component. Right now, you know you're comfortable because stocks have been doing well. So we're always comfortable when they have been doing well. Go take the risk quiz at talkingrealmoney.com and just see how you psychologically score. Just do that for me.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
It's your money, it's your life. It's what we talk about on the show, and we do it with you if you call us. We'll do it without you if you don't call us, but we'll do it with you if you call us at 855-935-TALK. I'm Don, that's Tom, and we're part of this giant organization.
Vestory by Applebee's. I got to give Paul credit for this because he came up with it. Vestory by Applebee's. Listen carefully. We offer diversified no-load portfolios plus bourbon steak Bourbon Street Steaks.
You blew it.
I know, and Oreo shakes. Bourbon Street Steaks and Oreo shakes. Thanks, Paul. That was really fun.
Investing good in the neighborhood.
My question to him was, which one's worth more, the steaks or the financial management?
You better be careful with that one. 855-935-TALK is our phone number. Give us a call, 855-935-8255. And Terry, you're up next. Welcome to Talking Real Money.
Hey,
Hey,
I
Terry.
called you for the steak.
You called for the steak. I figured you would, too.
Okay.
Kobe beef.
Hey,
Yes, sir.
I'm about ready to hire somebody. I really enjoy your program. I like the fact that you guys, you'll criticize, but you'll also praise some of your competitors. Now, why should I hire you?
Tom, I'll leave that to you.
Why? Which
'Cause
competitor do we ever praise? Come on.
Oh, we
Nah,
praise
kidding.
competitors. No.
Why should you
There's
hire
several
us?
of them, and there's several of them that we think highly
Yeah,
of.
they think they do a good job.
Because
So-
they do like we do.
Okay, the first part is, we've talked about this. The first part is anyone you hire should be a 100%. Here's the important part. 100% fiduciary. In other words, most people in this business will say they're fiduciaries because it's a great marketing ploy. We'll always put your interests ahead of our own. But most of them
Always.
are only for a part of the time. They're duly registered so they can be that fiduciary, but they can also sell you a product. That's number one. Number two, the planning part of all this, the not as so exciting as getting rich part, the center of any financial work should be the financial plan. And the people you hire should be working with the very best tools. There's some good tools out there. There's some not some good tools. I think we've got the best tools, frankly. Really
Well,
do.
and one of the reasons we merged with Applebee's was because
I thought it was the shakes. Look at
it was
me.
because you would know it by looking at them, but they've got great research.
Yeah, no, research is an important part, which brings me to the other part, and that is the what they use to invest in. Now, this is part of our work with Appella Capital, not Applebee's. Still funny. But when we merged with them, they have portfolios that they have people spending more time on than we did because we're a smaller firm. They have more research, more people there, CFAs, et cetera. And we now use exchange traded funds that cost 0.1% a year. I mean, these are dirt cheap.
Yeah, we were actually able to get our clients' fees for the assets that we were using down by more than, on average, more than 20 basis points.
And here's the kicker. I think still for us over maybe somebody else. There's other people in the market that do those things that we just mentioned. Well, we still have the foundation of education. There are people that talk to us all the time that say, hey, I really need you. And you go buy that fund. Where other people you might go to that say, oh, I really need you. And they would say, sure you do. Let me move you right into this product. We are ethical. And I think that's important. And we're based on education because Don and I have done that for these 30 years or so. So it's been an important
Way
part.
too
Is that a good answer, Terry, or not?
Well, it is, but here's my question. So I see the ads on TV all the time for the Fisher Investment Group. We do better when you do better.
Yeah.
So,
Yeah.
Well,
why
we're
would
compensated exactly the same way, by the way.
Fisher, we match up because they charge a percentage of the money that they manage. And by the way, they're 180 degrees from what we believe about money management. Ken Fisher is a longtime writer who started a money management firm, 30 odd years ago, and picks stocks. That's completely different than the approach we think you should use. It's academic based, wide diversification, totally different than what Fisher
And
would
by
do.
the way, Fisher's top fee is 1.25%. Our top fee is 1. Their fee on $2 million is 1.2. Ours is
Tom and Don
0.75.
are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And we hate the fact. We truly do. And actually, it's in our best interests. But we hate the fact that the vast majority of financial services and financial advisory firms are not always required to act as fiduciaries, charge horrible fees, and really take advantage of people. We would think, oh, this is great. It puts us in this rarefied company. We wish every advisor was required to act as a fiduciary. We'd love it if you could go to people and go, I trust that they're going to take care of me. But the problem is, and this is not us saying it, this was Market Watch saying it, that 99% of financial advisors, people who provide financial advice, are not always required to act in your best interests.
And you would think ethical organizations, brokerages, etc., would want to be always right. I mean, because you come in, you meet with the friendly broker, and you know you're going to get a fair deal. They don't. They fight that. Remember, it almost happened like a decade ago after the 2008 meltdown, and then it all sort of
but
whispers out.
Now they have years ago, 20 years ago, you couldn't get fee advice from a J.P. Morgan Chase or a Morgan
They've added
Stanley
that on. Yeah.
or Merrill Lynch. They've added the fee because the demand for fee work was so high.
Sure.
But this is what I wanted to mention. I didn't have time before the break. I just want to give you a quick look at what the fee structures look like. This is all available, by the way, at talkingrealmoney.com/help. But if you go to Ameriprise, and I got all this information from the firm's own ADV Part 2, a form they file with the Securities and Exchange Commission, okay?
Federal
I'm not
agency.
making this stuff up.
Yep.
Ameriprise maximum fee, 3.07.
That is outrageous.
Edelman Financial Engines, a fiduciary.
Yeah, how much?
100% fiduciary. Top fee 1.75.
But you get Bitcoin there, so that's add-on.
But the good news is they have breakpoints, and so if you get to 2 million, they're 1.07.
I still think it's pretty high, but
high.
okay. Yeah.
Fisher, and we didn't mention this enough. Fisher's philosophy is, we think, terrible. It's all about buying the best stocks, and we don't believe anybody, and the data supports this. We don't believe anybody can pick stocks successfully.
Well, they can pick them. They can't pick the right ones.
Right. And Fisher got rid of his mutual funds.
Yeah,
he used to have
wonder
mutual
why.
funds because they weren't beating the market. So his maximum fee is 1.25%. His fee on 2 million is 1.187.
Still a little spending.
Merrill Lynch is 1.8 for the maximum fee. Morgan Stanley is 2. Voya is 2.5. Wells Fargo is 2.5. And that's why we say, people say, well, the fees are about 1%. No, they're not. Fees in the industry may be about 1% on multi-million-dollar accounts.
But when you come in with $500,000, as Fisher suggests, it's far more.
It's far more. There are few companies. Ed Jones, I have to give them credit. By
Really?
the way. I do.
You're not feeling
Ed
well.
Jones maximum fee
Uh-huh.
for their fee accounts. I just wish they sold more of them as opposed to mutual funds. But their highest fee is 1.44%, which is low for the industry. So anyway,
Frankly,
check it.
there you go.
Check it out. TalkingRealMoney.com/help. You can compare. And the phone number is 855-935-TALK. And Heidi is up next. Hi, Heidi. Welcome to the show.
Hi, thanks. So I have a question about my parents. So my parents are in their early 70s and they're retired. And my dad has some cash that he would like to invest somewhere. And he's asked me for help, and I have no idea what to say. So I was hoping you could help.
It's not true. Why did he ask you for help?
Well, people don't know where to go.
I know. See, that's the problem.
So, but do you have a background in this business? He
That's
just
why I was
trusts you? I mean,
curious.
that's
No, well,
unusual,
no,
but-
not. I mean, not exactly. I do some investing on my own, and I pay careful attention to things like, fees, and I'm a big fan of index funds and all of the good things. But I know what to do for myself and my family, my little family. I have no idea what to do for somebody like my dad who is retired, and I've heard the rule that if you're going to need the cash within 5 years, you shouldn't be investing at all. You should still be in cash.
Yeah.
So it's like I just, if it were me taking the money and investing it, I would have a pretty good idea of where to go with the money.
Did you
But
ask your
with my
dad any of the
I
big
don't know.
questions? Did you ask him, What is the money eventually for? How much volatility, not risk, but how much volatility can they stand in their retirement?
And how much of this is he going to need in the next, 15, hopefully 20 years if he has that in his life? Those would be questions you'd want to ask first. Number two, I love what you just said a minute ago, something about index funds. I mean, your dad could put it all in the Vanguard Balanced Index Fund. That's like 60%, 60% in stocks, 40% in bonds. You hope to make 7 or 8% a year, not too much volatility or some volatility, but that's a perfect sort of one fund solution at a very low price.
How much money are we talking about, Heidi?
Probably around $150,000, so it's not a ton. But
it's cash. That's a ton.
It is really, really. I would say it's a substantial part of their portfolio, which is the the other part of this. And I think I feel like they probably will need a substantial portion of it within the next 5 years or so. And also, I would love to see them, because they are retired, I would love to see them just take it and go do something fun with it while they still can, right? That it's not all about the return on investment, but it's actually being able to use it to, for what it should be used for, which is to add joy to life, right?
Which I think is
great statement.
Yeah, is really underrated.
Yeah.
Heidi, you probably know a little bit about their finances. How are they doing right now? Where is their income coming from? Do they have pensions? Do they have other assets that are spinning off income?
They do. Yeah, they do. So they have pension.
Just covering the basics.
Are they exactly? Are they covering their basics?
They are.
And what would happen should they face a serious, long-term, debilitating illness, or something that just happens that requires some sort of long-term care? Do they have any coverage for that?
I don't think so.
See, that's where we come back to the importance of that.
I still like your suggestions. No,
spend
I like
some of it.
Yeah, spend some of it, but then I love either the Target Date Fund, do a 2025, or the Vanguard Balance Fund, because still out of the 150, you're going to have 40% of that money in bonds, not very volatile.
Yeah, I'd probably do a 2020.
So then now you're looking at 40% in stocks, 60% in bonds. Okay,
but
2020.
I think you're right. If you can convince them while they're young, and I'm sorry, but from my perspective, they're still relatively young.
They are young. Come on.
And to go do something they absolutely love with that money, just to do it now.
Just take some part of it and go do that. And then take the rest of it. Yeah. And then invest the rest of it. I think that's a great idea, because what you just said about money is overlooked often, and it should bring you the joy. I mean, this is something you save, et cetera, et cetera. Go do and enjoy it. I think that's fabulous.
Yeah. And if you go with like a 40-60 fund, 40% stocks, 60% bonds, you're not going to have a great deal of volatility. You have zero risk of total loss, in my opinion. Zero risk of total loss. The entire world economy would have to collapse, and in that case, who cares where the money is? That would give them the means by which to take some out in an emergency, to grow it a little bit more, so maybe it's going to be more helpful down the road. Thanks for the call, Heidi.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Bourbon steaks and Oreo shakes every Saturday.
And we'll be serving Applebee's at Retire Meet.
No, we won't. We got those special sandwiches from Maidenbauer. They're doggone good.
Doggone good. Yeah, we're doing Retire Meet. We're going to try and do it live in 2022, live and online. Retire Meet 22. It takes place in February. You can get tickets right now. Go get them right now at retiremeet.com, retiremeet.com.
We hope
hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.